If I feel like the market is playing game with you, you do everything right. You follow setups, watch hours of content, test indicators, even take notes on what the pros do, and sell the chart flips the moment you enter. It's frustrating. Not because you don't understand the trading, but because what looks obvious after the fact never feels that clear in the moment. Here's the truth most traders never admit. You can fight uncertainty, but you can recognize very smart money moves. And once you learn to see those footprints, trading starts making sense in a way that indicators alone never could. But because the goal isn't to predict the market, it's to understand where price is most likely to react. And that's exactly what this strategy does. We're going to break down a system that identifies where big players quietly buy and sell without guessing, without lagging signals, and without staring at charts all day. It's simple once you see it, and the best part, it works across any pair, time frame, or session. And before we dive in, I need to mention that this video is for educational purposes only, not financial advice. Always test and manage your own risk before trading live. Alright, let's get into it. Every market moves because of one thing: imbalance. At some prices, everyone wants to buy. At others, everyone wants to sell. Those points of imbalance form what we call demand zones and supply zones. Now, don't overcomplicate it. A demand zone is simply a price area where a strong buying pressures once took over, pushing price sharply higher. It's like a hidden pocket of orders where institutions stack their buys before the markets took off. So when price revisits the same area later, guess what often happens? Those big buyers usually defend it again, creating a bounce or reversal opportunity. And a supply zone is the exact opposite. It's an area where sellers overwhelm buyers, forcing a sharp drop. When price climb back into the area, the same sell pressure often returns. Another potential turning point. Now, here's the issue. Finding and drawing these zones manually takes time and precision. You could spend hours identifying levels only to realize they weren't clean or fresh. That's where a powerful tool helps. The flux charts MTF supply and demand indicator. This indicator automatically scans the chart, identifies valid zones, and plot them with clean visual demand and supply. It doesn't just mark levels, it highlights reaction areas where price historically shifted direction with a strength. But that's not all. It also generates signals marks directly on the chart when those zones get broken or respected. For instance, when price breaks through a demand zone with momentum, it prints a break alert right at the candle, telling you when momentum has shifted. So check this out. Price revisits a demand zone, breaks through it with force. That's a clear bearish sign. Or price pushes through supply, that's a potential bullish continuation. It gives you a real-time visual confirmation of a structure shifts without needing to draw a single line yourself. But let's be honest, no indicator, no matter how good, can replace context. That's where most traders mess up. They find zones but trade them blindly without checking the overall trend. So here's how to add a structure and precision to your setups. Use a second tool called the swing arm ATR trend indicator. It's not just for looks, it's show you exactly which side of the market has control. Now, here's the secret to getting it right. Don't use the same time frame for both indicators. If you're trading on the 15-minute chart, set your swing arm to 30-minute time frame. That higher view filters out noise and helps you align with the dominant market direction. Then adjust both ATR period and ATR factor to 10 for optimal responsiveness. And to keep your chart clean, disable everything except the fib and background plot options. It'll look sharp and focused. Now you've got the structure. Flux charts gives you zones, swing arm gives you the trend bias. So let's put all together, and here's exactly how to trade it. When the swing arm ribbon is green, the trend is up. That means you're focusing only on bullish opportunities. Ignore all bearish breakouts or short setups. So in this example, we've got a clean uptrend, price pushes above a supply zone, and the indicator prints a bullish breakout signal. That's your entry cue. Open the buy position once the breakout candle closes. Set your stop loss just below the recent swing low and target a 1 to 2 risk to reward ratio. Now here's the logic. When the trend is strong and a supply zone fails, it means sellers have been absorbed. The market's telling you momentum favors buyers. That's exactly the kind of setup we want to ride. But here's where the most traders lose money. They try to trade every zone. Don't. In an uptrend, ignore demand zones breaks. Those are counter trend signals. Focus only on the bullish continuation and confirmed breakouts. Now fill up the logic for a downtrend. When the swing arm ribbon turns red, look for demand zones break. Ignore bullish setups completely. So, your core rule is simple. Trade with the trend. Follow breakout confirmation from the flux charts indicator and ignore counter trend noise. In an uptrend, when price retests a demand zone, that's where the buyers often step back in. And in a downtrend, when price retests a supply zone, that's where sellers reload. It's the same logic, just different entry style. Both work when aligned with the trend and confirmation. The key is patience. You're not chasing moves. You're waiting for them to align. And once you start thinking like that, the chart stops looking random and it starts making sense. And if you want to grab the flux charts MTF supply and demand indicator, there's a link with 15% discount in the description and pinned comment. Happy trading!